Welcome back to Investing Talk Podcast.
Today, we're looking at Robinhood.
As usual, before we start, subscribe, like, and comment to this video to support the show. Because today, we are unpacking a corporate evolution that is genuinely fascinating. Think back to where this company was just a few years ago.
Right, the whole meme stock era.
Exactly. We all remember the headlines, the gamification, the digital confetti falling on your screen when you bought a stock. It was the app you downloaded in your dorm room to buy $50 of a dog-themed coin, basically hoping to catch lightning in a bottle.
Yeah, famous for retail day trading and, frankly, a whole lot of market chaos.
Yeah, but looking at the latest data, that chaotic startup narrative, it seems completely outdated now. They're playing a much bigger game.
They absolutely are. What we are witnessing right now is a deliberate, highly aggressive transformation. I mean, the platform is no longer just a casino for retail traders.
Right.
They are systematically building out a sprawling, diversified financial super app. We are talking about an ecosystem engineered to capture, well, every single aspect of a user's financial life. They want to be the place where you do your daily spending, where you hold your long-term retirement accounts, where you trade your crypto and park your emergency savings.
Which sets up the central tension we need to untangle for you today. Can a platform that built its entire cultural brand on hyperactive, sometimes highly volatile retail trading actually mature into a stable, legacy-style financial powerhouse?
That is a big question.
Or, despite all the shiny new features and premium credit cards, are they still fundamentally chained to the wild, unpredictable swings of the crypto market?
That is the multi-billion-dollar question, honestly. The brand perception is still catching up to the reality of their balance sheet. And to really answer that question, we had to push the meme stock legacy aside and focus entirely on the hard financial mechanics operating under the surface.
Let's pivot to the fundamentals and look under the hood. Because the fiscal year 2025 numbers look, quite frankly, staggering on paper. We are looking at total revenue hitting $4.5 billion. That is a 52% year-over-year increase.
Which is massive.
Right. I have to put my skeptic hat on for a second here. How is a company that relies heavily on zero commission trading pulling a 52% revenue jump at that kind of scale?
Well, a 52% jump at a multi-billion-dollar scale is incredibly rare in the financial sector right now. And when you break down that $4.5 billion, the underlying engine of their business model becomes very clear.
Okay, break it down for us.
Transaction-based revenue is still the primary driver. That came in at $2.6 billion, which is up 50% year over year. But the real unsung hero here is net interest revenue. That hit $1.4 billion, representing a 25% increase.
And for anyone who isn't staring at bank balance sheets all day, net interest revenue is essentially the money they make off the uninvested cash sitting in your account, right? Yep. They take the cash you haven't bought stocks with yet, they earn yield on it, and they keep a portion of that margin.
Precisely. It is a highly reliable, low-effort revenue stream.
Mm-hmm.
And then you have their other revenue category, which includes subscriptions like their gold tier, and that segment more than doubled to $338 million.
So 3 distinct engines firing simultaneously.
Yeah.
I want to zoom in on the fourth quarter specifically because the internal mix of how they're generating that transaction money is wild. Total Q4 revenue was $1.28 billion, up 27%. But look at where the actual trading volume lives.
The options.
Yes, options trading absolutely dominated the quarter. It generated $314 million in Q4 alone. Compare that to traditional equities, just buying and selling regular shares of a company, which only brought in $94 million.
Wow.
They are making more than 3 times as much money on complex options contracts as they are on traditional stocks.
Which tells you a lot about their core demographic. Traditional equities are great for long-term holding, but options offer leverage. They offer complex, multi-leg strategies and higher risk, higher reward. That highly active, risk-tolerant trader demographic is still very much alive and well on the platform.
Really?
But what's truly impressive from a corporate standpoint is how efficiently management is monetizing that high-frequency activity. Let's talk about profitability, because this is where the narrative really shifts. For fiscal year 2025, net income reached an impressive $1.9 billion. That translates to a diluted earnings per share of $2.05.
And the margin profile is what really caught my eye as an analytical data checker. Adjusted EBITDA, which is basically a measure of their raw operational profitability before accounting for things like taxes and depreciation, hit $2.5 billion. That means they are operating at 56% profit margins.
Yeah, that's huge.
In the fintech space, operating at a 56% margin is almost unheard of. It implies an incredible level of operational leverage.
That operational leverage is the key to their entire valuation model. Think about it. Once the core app architecture is built and the servers are running, adding one more user or processing one more options trade costs them practically nothing. The friction is zero. So every new dollar of revenue they generate drops almost straight to the bottom line.
But you don't get to those margins without serious scale. And that brings us to the financial health and the competitive moat they're trying to build. By January 2026, total platform assets ballooned to $324.4 billion. That is a 59% year-over-year
It's
increase.
a massive growth.
And it's crucial to point out that this isn't just the stock market going up and inflating their numbers. It is driven by actual physical capital inflows. They brought in $67 billion in 12-month net deposits. People are moving serious tangible wealth over to this platform.
And the user base backs up that capital migration. They now have 27.2 million funded customers. But here is the critical vulnerability and the entire reason they're building this super app. How do you keep those 27.2 million people from taking their $324 billion to a traditional legacy broker the moment they decide to grow up financially?
Right. If I hit 35 and decide I want a serious retirement plan and a premium credit card, what stops me from migrating my assets to one of the old school banking giants?
You stop them by building a moat based entirely on high switching costs. You make the ecosystem so comprehensive and so deeply integrated into their daily life that leaving becomes a logistical nightmare.
I see.
They're doing this by aggressively diversifying their offerings. They now have 11 different business lines that each generate over $100 million in run rate. Think about the scale of that. Options, equities, margin lending, high-yield cash sweep accounts, specific retirement products, 11 distinct pipelines generating 9 figures each.
It's basically the Apple ecosystem strategy applied to personal finance.
Exactly. Once a user has their IRA, their active trading portfolio, and their daily spending card all living inside one app interface, the friction required to leave is just too high. They are locked in.
And the company's capital allocation strategy reflects a ton of internal confidence in that exact moat. Since the third quarter of 2024, the company has deployed $910 million in share buybacks. Now, historically, their average purchase price on those buybacks was hovering around $55 a share.
Right.
But what I find fascinating is that they haven't taken their foot off the gas, even as the valuation has climbed significantly. Quarter to date, they have spent another $173 million buying back shares at an average price of around $84.
Which sends a very loud signal to Wall Street. It tells analysts that management believes the stock is still fundamentally undervalued, even at those significantly higher price points. They're generating sweeping amounts of free cash flow from those 56% margins, and rather than hoarding it, they are choosing to return it directly to shareholders by retiring outstanding stock. It's a highly mature, textbook corporate maneuver for a company that the old guard used to view as a chaotic flash in the pan.
All right, so management is confident enough to buy their own stock near $84.
If we transition over to the technicals and recent price action, that newfound maturity is being stress tested by some serious volatility.
Oh, absolutely. Shares are currently trading around $76.07, and the short-term ride has been bumpy, to put it mildly. The stock is down over 23% in just the last 30 days, but if you zoom out and look at the broader picture, the one-year total shareholder return is an incredibly impressive 64.58%.
That stark contrast in volatility is exactly why this stock requires such careful analysis.
Yeah.
You have these severe double-digit monthly swings, but the overarching structural trend has been highly rewarding for long-term holders. And we just saw a prime example of a near-term catalyst. On March 4th, shares suddenly surged 7.9% in a single trading session.
And we have to be absolutely clear about what drove that 7.9% pop. It wasn't necessarily a change in their fundamental banking model or a new retirement feature. It was directly, unequivocally tied to a sweeping rally in the broader crypto market.
Right, Bitcoin.
Yeah, specifically, we saw Bitcoin rebounding and surging to $74,000. When Bitcoin runs hot, this stock runs right alongside it.
The flow mechanics behind that correlation are fascinating. We are seeing surging volume driven entirely by crypto-linked gains across the sector. It wasn't just them. Peer companies with heavy crypto exposure were seeing identical double-digit moves that week. That external crypto momentum was strong enough to pull the stock's momentum out of a really ugly 6-month slump.
It really was an ugly slump.
It was. And this is the paradox of their business model. It shows that despite the 11 diversified $100 million business lines we just praised, The market still treats their crypto trading volume as a primary engine for near-term price discovery.
Moving over to market sentiment and what the analysts are saying, it's interesting because the narrative is trying very hard to break free from that crypto dependency. The qualitative sentiment in the financial press right now is overwhelmingly bullish. But the top news stories aren't actually fixated on retail trading volume or Bitcoin at all. They are entirely focused on forward-looking growth narratives and product expansion.
Right. The market is currently incredibly hyped about their Take Flight product launch event.
Hmm.
This is the clearest signal yet of their overarching super app ambitions. They are making a very aggressive, calculated push to capture affluent investors with a new premium credit card.
It's a huge shift.
It's a monumental paradigm shift. They're going after the high net worth wallet share that historically belongs to legacy credit card issuers and premium banking brands.
It's an unbelievably ambitious leap. They are trying to go from being the app where college kids bought fractional shares of gaming companies to being the heavy metal card you drop on the table at a high-end steakhouse. And the market loves the ambition of that pivot. But alongside the confirmed product launches, there are some serious unconfirmed rumors swirling around that suggest they are going even further. There is heavy speculation that they are pushing deeper into prediction markets, expanding into private equity access for retail investors, and building out much broader traditional banking services.
The prediction market trajectory is particularly compelling, especially given the rising popularity of event-based forecasting. Right now, that specific segment is sitting at a $100 million annualized run rate for them. But the internal tracking suggests it is pacing toward a $300 million run rate.
This is a massive jump.
It is. If they could successfully monetize event-based forecasting at that scale, it becomes a vast, high-margin revenue pillar that is totally uncorrelated from whether the S&P 500 or Bitcoin is up or down on any given Tuesday.
And analysts are definitely buying into this forward-looking trajectory. The Street consensus is projecting $5.5 billion in total revenue for fiscal year 2026. That would be a 22% year-over-year increase on top of the monumental growth they just delivered. Furthermore, they expect those EBITDA margins we praised earlier to expand even further, hitting 59%.
When you combine 22% top-line growth with expanding profit margins hitting a 59% clip, the resulting free cash flow generation is going to be an absolute tidal wave. It entirely justifies the aggressive $910 million share buyback program we discussed. They have the cash to defend their stock price while funding expansion.
But it's not all green lights. Let's flip the script and dive into the bear case, because as analytical investors, we have to stress test these pristine projections against reality. And the biggest, most glaring red flag sits right in the fourth quarter data.
The crypto miss.
Yes.
Yeah.
Crypto revenue came in at $221 million. Now, in a vacuum, that sounds like a lot of money, but it actually missed estimates by a whopping 38% sequentially.
I won't sugarcoat it. A 38% sequential miss is brutal. It highlights exactly what the skeptics fear most about this company. The revenue quality is highly unpredictable. When you rely on transaction volumes from an inherently volatile asset class, your quarterly earnings are going to reflect that volatility.
Exactly. And the picture gets worse when you look at the start of the new year. January app volumes were actually down 57% year over year. A 57% drop in trading volume is the kind of metric that keeps executives awake at night in cold sweats.
Definitely.
And the broader market has punished them for it before. Keep in mind, this stock previously saw a 50% plus pullback from its historical highs of $153.86. The market has shown time and time again that it will ruthlessly reprice this company if that heavy reliance on crypto swings turns into a liability.
You're absolutely right to highlight the gravity of that volatility risk. And there's another underlying metric in the bear case we need to acknowledge, which is the pace of their customer growth.
Right.
We noted the surge in total platform assets to over $324 billion, but the actual human user base growth is noticeably decelerating.
Right, the new account numbers.
Yeah, they added 1.75 million funded customers, which is only a modest 7% year-over-year increase. They're getting exponentially better at monetizing their existing users and pulling in more deposits from them, but the days of viral word-of-mouth exponential user growth seem to be permanently in the rearview mirror.
We also have to factor in the regulatory crosshairs. There is intense ongoing scrutiny surrounding payment for order flow. And for anyone who needs a quick refresher, payment for order flow, or PFOF, is essentially the engine of their commission-free trading. It's how they make their money by routing your trades to market makers for a tiny fraction of a cent. If regulators squeeze that mechanism, it threatens their core equities business. And now, by stepping into prediction markets, they are inviting a whole new wave of regulatory oversight from entirely different government agencies.
Those are valid, serious hurdles that could compress margins. However, I would argue that these risks are manageable today precisely because of the fundamental super app transformation we outlined at the start.
Okay, how so?
Well, if payment for order flow gets regulated heavily, or if crypto enters a multi-year deep winter, it certainly hurts, but it is no longer an existential threat to the company's survival. They have those 11 distinct $100 million plus revenue lines acting as structural shock absorbers. The net interest income alone provides a massive buffer. And underneath it all, that $910 million buyback program provides a very real, tangible safety net for the share price. The floor is simply much higher than it was during the last crypto crash.
I understand the shock absorber argument, but we cannot ignore the sheer gravity of external macroeconomic forces on this stock. We talked earlier about Bitcoin surging to $74,000 and pulling this stock up 7.9% with it. What we need to impartially note is the specific catalyst behind that Bitcoin surge. It was heavily tied to momentum surrounding a new political crypto bill.
That's a great point.
Now, to be absolutely clear to you listening, we are reporting this strictly as market catalyst. We take no political sides whatsoever. But as an analytical reality, we have to acknowledge how heavily this company's technicals are tied to external macro-political forces. A single piece of legislation or a sudden shift in political winds can send their underlying asset class soaring or plunging overnight. That is a level of systemic risk that traditional legacy banks simply do not face to the same degree.
Bringing this all together for our final verdict, you ultimately have to weigh that external volatility against the internal operational execution. And when looking at the quantitative modeling of their cash flow, margins, and growth, the result is highly compelling. Based on the research, we are looking at a bullish score of 8 out of 10.
An 8 out of 10 is a strong conviction rating from the models. Break down the ultimate investment thesis for us. If you only had 30 seconds in an elevator to pitch this to a portfolio manager, what are you telling them?
The elevator pitch is this. Management is successfully executing a multi-year super app build-out, and the broader market hasn't fully priced in the reality of that transformation yet. Currently sitting at a 35x PE ratio, the valuation suggests strong upside potential when you factor in the underlying mechanics. You have structural profit margin expansion pushing toward 59%. You have a highly sticky ecosystem holding $324 billion in assets. And you have a management team continuously supporting the price floor with relentless share buybacks. They are successfully bridging the gap from a niche retail trading app to a foundational, diversified wealth management platform.
And from a tactical standpoint, defining the time horizon for you is crucial here. In the short term, this is being positioned by many as a swing trade into the upcoming earnings report expected on April 29th, 2026. The street will be looking for a sharp reacceleration in those January volume numbers.
Yeah, that will be a key catalyst.
But fundamentally, if you are buying in at these levels, it serves as a multi-year hold. The thesis relies on their dominant market share in options and crypto, combined with their ability to cross-sell those new premium banking products to that expansive user base over the next decade.
The transition takes time, but the architectural foundation for a financial juggernaut is clearly in place.
Which leaves us with a final, provocative thought for you to mull over. We've talked extensively about their aggressive push to capture affluent, high-net-worth users today with the new premium cards.
Right.
But what happens in the next 10 to 15 years when the younger demographic, the exact generation that cut their teeth buying fractional shares on this platform in college, inherits the greatest generational wealth transfer in history? If the high switching costs of this super app hold true, this platform might not actually need to hunt for tomorrow's affluent investors at all. They might already have them securely locked into the ecosystem, just waiting for their account balances to grow. It is a fascinating long-term dynamic to watch unfold.
It really is.
As usual, before we sign off, remember to subscribe, like, and comment to this video to support the show. Your engagement helps us bring you these comprehensive breakdowns every single week. Thanks for joining the Investing Talk podcast, and we will see you in the next one.